I've always done my best to get in the company of people who have accomplished the things I want to accomplish already, and through that process, I've been able to hear the perspectives of some extremely successful real estate investors and senior commercial real estate executives that have been in the industry for decades, some even longer than I have been alive. And these conversations usually leave me with some really good insights into where I might be overlooking something, some potential downsides of a deal I'm considering investing in, or just a general flaw in my overall investment strategy that needs to be tweaked in order to mitigate some sort of risk. And some of the most valuable pieces of feedback I've received through having these conversations have actually been around what these people consider to be their biggest regrets during their time in the industry, and in their eyes, what they could have done differently to achieve that success either more quickly at an even higher level or with less risk than they took on to move towards whatever it was that their goals were. And since I've personally found these insights so valuable, in this video, I wanted to share 3 of the lessons that I've taken away from all of these conversations, specifically around what these people who have experienced so much success wish they would have done differently during their careers, and what we can take away from these regrets as real estate investors to make better decisions of our own. So hindsight is obviously 2020 and past returns don't guarantee future performance, but I think one of the most helpful ways to shortcut any sort of learning curve is to learn from those who have gone before you. Investors become more skilled over time because they're able to see what works and what doesn't, and by listening to people who've walked down a path that you want to take in the future, there's not much more of an efficient way to spot potential landmines and holes in your plan. And for me, I've always tried to stack the odds in my favor of making the best investment decisions I can by trying to learn from people who have successfully accomplished the things I'm looking to do in order to constantly improve that decision-making process. And in my career, through things like academic connections, industry relationships, and companies I've worked for and consulted with over the years, I've had the opportunity to sit down with some extremely accomplished people in the industry, ranging from individuals with personal real estate portfolios valued at over $100 million to the founders and CEOs of multi-billion-dollar real estate enterprises. And this video is my attempt to condense what I've learned from these people who have essentially won the game already, specifically around what these people tend to actually regret and what they do differently if they could rewind time and do it all over again. So the first thing on this list that I've heard over and over again is, I wish I would have bought more sooner. This saying honestly feels like it's on repeat every time I ask the "do you have anything you would have done differently" question, and this is a really, really big one. And this regret usually isn't referring to not being able to time the market properly, but primarily around not being in the market for long enough and not taking advantage of the substantial value increases that have occurred so consistently throughout the last several decades here in the US. And barring any sort of crazy circumstances like we saw in 2009 and 2010, or at certain points for certain product types in 2020, at any given moment in time, real estate almost always feels extremely expensive or potentially even overpriced in the present tense. However, when I personally look back at investments I made just 5 years ago, what felt like potentially buying at the peak at that time now just looks like an absolute steal on paper and pricing that I'm not sure I'll see again throughout my entire lifetime. The constant theme here that I've heard over and over again from some of the most successful investors I've interacted with is the push to get in the game even if it's small. Put your chips on the table, even if it's just the purchase of a single family rental home or a small investment in a syndication, and get the ball rolling in any way you can. You'll learn a lot in the process of actually managing that investment or even just watching how the partnership is managed, but doing this also helps you start to build momentum and will give you the confidence necessary to go into the next deal and the next deal and the deal after that. And getting into that next deal is the only way to really build something substantial over time and also to build the knowledge base that you'll need to be successful in the real estate game long term. Now, the second regret that I've heard over and over again from experienced investors is that they wish they hadn't sold many of the deals they had sold in the past, even if those deals were profitable at the time. With very few exceptions, US commercial real estate values have gone up in almost every year throughout our entire lifetimes. And when you start to compound that growth, the numbers on something purchased 30, 20, or even just 10 years ago start to get pretty impressive. I reference the Green Street Commercial Property Price Index a lot on this channel because this tends to be such a great benchmark for overall price fluctuations in the market. But if we take a look at the numbers in this index back as far as they go, US commercial property values have grown by 287% since December of 1997, which is equal to a compound annual growth rate of about 4.6% during that time. But if you also consider that most commercial real estate properties are purchased with loans, even if you assume a relatively conservative 65% LTV ratio and zero principal payments throughout the entire time the property is owned, that total equity value growth jumps to over 633%, or a compound annual growth rate of 8.1%, and this isn't even factoring in any operating cash flow generated by the property. And even though finding any sort of significant cash flow in today's market isn't easy, cap rates in the industry for many asset classes used to commonly sit in the 8 to 10% range, or even higher in some cases, making a cash on cash return of 10% or more a very real possibility for commercial real estate investors over the past few decades. All of this adds up to compounded annual returns that have more realistically probably been in the mid to high teens for many real estate investors who have held on for the long term, which, along with the tax benefits of owning real estate, can create some serious wealth over time. Selling real estate also involves transaction costs, which over an investing career can create a significant drag on returns between brokerage commissions, legal fees, transfer taxes, and even capital gains taxes on properties that aren't exchanged. Selling a property also puts a tremendous amount of pressure on investors to redeploy that capital into the market, and with the tax benefits of a 1031 exchange, it's hard not to make a case for going that route. However, if you're selling in a hot market, you'll also be buying in a hot market, meaning that for every trade you're making, you're also increasing your basis on each deal you buy as a byproduct of locking in those gains. There are always going to be times where it does make sense to take your chips off the table, and another common saying I've heard over the years is that no one ever went broke taking a profit, so that's definitely not to say that it's never the right move to sell, but historically there have been a lot of reasons why it would make sense to hold onto a deal long term rather than consistently trading in and out of the market. And then finally, the biggest and definitely the most painful regret I've heard from veteran investors if they could do things all over again is that they wish they had used more conservative leverage, specifically heading into tough economic times. Taking a look at how significantly commercial property prices have increased over the last 20 plus years, it's pretty easy to see that most investors have done pretty well during this time, assuming they've just matched the market. However, real estate is a cyclical asset class, and for various different reasons, there have been some down years in CRE during this time, and if investors have lost money during these periods, over leveraging is usually the main reason why this occurs. Common war stories I've heard involve being in situations where the investor was forced to sell due to a loan maturity at a time when property values had dropped significantly and no lender would refinance the deal, when an investor sold at a loss due to cash flow strains at the property with no end in sight, or even when an unexpected major tenant vacancy drained all cash reserves in just a few short months, even during normal market conditions. In any case, even if higher leverage points magnify returns on good deals, higher leverage also magnifies risk at the same time. And when commercial real estate investors have lost money over the last 3 decades, it's usually been due to being over leveraged and not being able to weather the storm. On deals that aren't highly leveraged, even though valuation drops don't necessarily feel good at the time, investors with a long-term view can often ride these times out rather than being forced to sell at what often turns out to be the bottom of the market. And when there's just too much debt on a deal, you can find yourself in a position where the lender can end up making decisions for you when things get tough, which is never a place that you want to be. So if I had to boil down the most common regrets I've heard from people who have already won the real estate game, these are the 3 that almost always come up in every conversation. And if you're trying to build a portfolio of your own or trying to build a company with strong and consistent investor returns, I hope these three things are helpful in framing your decision-making process going forward and how you can leverage the experience of people who have successfully been there and done that and have accomplished what you might be looking to do. And if you're looking to learn more about the technical modeling and analysis skill sets you'll need to invest in commercial real estate deals, or you're looking to break into the industry and trying to jumpstart your CRE career, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to all Break Into CRE courses on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, downloadable acquisition, development, and waterfall models for multifamily, industrial, office, and retail deals. And you'll also get access to members-only private email-based career coaching if you're looking to break into the real estate industry and want some personalized guidance and feedback along the way. And if you like this video and want to see more videos like this on this channel, make sure to hit the like button to let me know, and let me know in the comments what your biggest real estate investing regrets are, or if you were also the beneficiary of some words of wisdom from an experienced investor in the industry. Make sure to drop those in the comments as well. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.